Okay, MegaWhale team, welcome back to the channel. Thanks for tuning into the video. Today's video is going to be quite an extensive video. We got a lot of different topics to talk about and a lot of different charts to go through. This is probably one of my largest videos to date. We're going to do a quick overview of what we're going to talk about, how we're going to talk about it, and then we'll get stuck in. So we're going to start with a market analysis of Bitcoin. We're going to be utilizing two different charts for this one. We'll utilize this chart here, talking about the support zones, the resistances, diagonal zones, and our bearish breakdown. Then we're going to bring up a separate Bitcoin chart and show our diagonal support zones, which we haven't actually shown you on the YouTube channel yet. We'll then talk about the total cryptocurrency market cap and our Bitcoin dominance. Then we'll go into talking about Bitget Exchange. We'll do our long-term price predictions and analysis using a log scale chart, the 24K prediction, the 100-day moving average, the ascending channel breakdown, the log scale on the RSI for 34.34 breakdown, as well as the baseline on Ichimoku cloud on the monthly chart. We'll then run through back to this chart and do a technical analysis on the weekly, the 3-day, the 1-day, and the 4-hour, leading into the FOMC discussion of the interest rates, the DXY, and how these can impact cryptocurrency, and finally talking about our community question. So our community question for today is submitted by Vinay, one of our long-term subscribers. I'm going to go ahead and bring it up on the screen now for you guys. He asks, MegaWhale, why does every coin depend on Bitcoin? When Bitcoin goes up, every other coin seems to rally, and vice versa. Why does this occur? So it's a really good question, and we can't wait to give you an answer for that one. We have a good explanation to why this occurs. So if you've been wondering in the past, and you probably maybe have been in crypto for a few months or a few years, you would have noticed that Bitcoin does control the market movements. So we're going to go ahead and explain that one at the end of the video. Before we do get started, I want to draw your attention to the pinned comment down below. Head over, click read more, and join our Twitter and our Telegram, and you can join up our VIP for daily trade signals, exclusive market updates, direct message access to myself, and much more. Let's dive right into the video. So we're going to get into a market analysis now, and we're going to go through two separate charts. The first chart is a chart that you see on screen here, and the second chart is an extension from that chart. As you can see, we still had that same ascending channel formation, but we have this descending channel encompassing the ascending channel. So we're going to go ahead and talk about that one in a second. We'll start on this one here. So an ascending channel is when you have two diagonal uptrending support or resistance lines, and you have the price moving between these two levels, and these levels are parallel to one another, meaning they do not converge or broaden as the periods go along. So we have seen that exact formation occur. To confirm an ascending channel, we need at least 2 retests on one side and 3 retests on another before having a support resistance flip on the downside, confirming the breakdown. If we go ahead and look at the ascending channel here, this is exactly what we saw. We saw at least 3 retests on the top side, at least 2 retests on the bottom side, with finally a support resistance flip on that dotted line, and finally a breakdown in the last 24 hours. So according to market theory of the ascending channel, we can confirm, in fact, we were in an ascending channel like we've been saying for many, many months, and we did in fact have a confirmed breakdown of the channel. We're going to talk a little bit about the 100-day moving average on the weekly and how we're finding a little bit of support on that, and we'll come back to where we think the price will be going on the longer term from this breakdown later in the video when we talk about our long-term price predictions. For the new viewers here, I want to quickly go over what these lines are. First and foremost, these red lines are indicative of horizontal support levels. These are particular, precise price points in the history of the Bitcoin price that have acted as levels in which there are considerably higher levels of purchasing and selling on the price action. So if we take a look, we have our 35,500 horizontal support, which happens to line up with the 7-day, 100-day moving average. Below that, we have our $30,000 support. Above us, we have our 40,000 psychological support and resistance. We have our 42,000, 42,500, 44,440, and so on and so forth. These gray boxes, which you will see mostly in the video today, are representing support and resistance zones. So a support and resistance zone is very much similar to a horizontal support. The difference is it states that between these two lines of the black box, we have an increase in selling and buying in comparison to every other period on the chart that isn't represented by a support zone. So you may notice that we sometimes have these red lines within these zones. It indicates within that support zone, within this gray box, that red line is the period within that support box with the largest amount of historical buy and seller pressure. So now if we extend that to our horizontal levels, we can say the same thing. essentially when we look at a horizontal level, which is this over here, this is exactly the same as what we see on the, diagonal level. This is exactly what we see on the horizontal chart. It is representing a support and resistance range. The dotted line represents the period on which it has the largest buying and selling pressure, and the solid line is another large period. Between these dotted and solid line represents weaker selling and buying pressure. What does that mean? Well, it means whenever the price comes down and touches the dotted line, we expect a very strong support. Support weakens until it reaches the black line, and then we expect a very strong support again. So theoretically, when the prices drop below the dotted line, we expect a major support level to be lost until we come down and retest that black line. But since we are in a support range, we can theoretically expect support within this range at any period of time. So if we come up here and take a look at the top side, we can see the same thing. When we break the black line, we expect a push upwards to the strongest resistance, which is the dotted line, which we saw on many occasions. But there were instances where we broke the black line, found support before the dotted line, and actually came back down, or should I say resistance. This is because between these two lines, we have constant resistance. It just indicates the periods on which have the largest resistance or support within that support range. So we're going to go ahead and talk about this chart here now. So keeping in consideration what we just talked about, we can apply the same logic to these downward sloping horizontal levels. It's exactly the same thing. When we break through these horizontal levels, it indicates we're taking a push or a move upwards to a stronger level of resistance on the downside, which is reflective or indicative of this downward sloping horizontal level, the upper level here. So we can see this on here. On the downside, we can expect the same thing. We have a weaker horizontal support, or should I say weaker diagonal support here with a stronger diagonal support below. If we lose this initial level, we can expect a move downwards to a stronger level here. But we can also expect the price to rebound at any point within this level. Why is that important? Why does that matter? Because it allows us to put our separate buying orders within or between these two black lines. And we know where our invalidation points are. So our invalidation points are below this level. So if we go back to our original chart and we apply that logic, our invalidation point for this uptrending move over here that could have occurred was actually in fact below the breakout or loss of this uptrending diagonal black line. So that being said, we have confirmed the breakdown. The bullish potential that we did have has now been lost in regards to this market structure. It would take a lot for the price to break back in. We're going to quickly just talk about real quickly how we would have to become bullish again, or what we would need to become bullish. First and foremost, we would need the price to obviously reclaim both this down, or should I say this uptrending solid line, the uptrended major dotting line, the $40,000 resistance, the 100-day moving average, and finally the price would need to reclaim 42,000 to 42,500, find out a support before flipping, and only then will we actually become a short-term bullish. For us to become macro bullish, we need to flip the 200-day moving average and get over this local high resistance level. So a lot of things above us before we can come bullish. And of course, we've talked a lot about the macro environment and the economy and how we're not really in any state to have some sort of strong uptrend. And we talked the other day about this recent move up and how it was just a FOMC driven pump. Usually they have pumps before or after the FOMC interest rates rise, especially when the market anticipates or is priced in the 50 basis points, and then we have a drop. We're going to come back and talk about that in a bit. So next up, we're going to go ahead and talk about the total cryptocurrency market cap. So the total cryptocurrency market cap is showing us something that we should also be very concerned about, which is a breakdown below this major horizontal support at 1.68 trillion. We talked a lot about this level in a previous video, saying that if we lost this level, we would most likely see a slow bleed down towards a 1.39 trillion level, which will result in Bitcoin touching at least 30,000 with the potential to go lower to $24,000. We have to keep in mind that this is in fact a breakdown of an ascending wedge formation. We had our actual retest of the ascending wedge over here, confirming the breakdown, rejection from the 100-day moving average, rejection from the 1.86 trillion, rejection from the 1.92 trillion, and finally a breakdown and failed to hold above the 1.68 trillion. It is looking kind of grim, guys. Moving on, the Bitcoin dominance chart is showing us something very similar, which is a consistent breakdown or rejection from this downward sloping diagonal resistance as well as the downward sloping 100-day moving average acting as a very major resistance in the previous move upwards. We talked a little bit about how the Bitcoin dominance chart can show the allocation of funds within the total cryptocurrency market cap, and how that can actually express or indicate whether or not money is going to flow between Bitcoin and altcoins. Usually when Bitcoin dominance drops, we see altcoins rally, except when we are in a macro downtrend, because in a macro downtrend, the total cryptocurrency market cap is falling at the same time. So when you have a discrepancy between the total cryptocurrency market cap, when the total cryptocurrency market cap is rising while Bitcoin dominance drops, we see money flow from Bitcoin to altcoins. When Bitcoin dominance drops while total cryptocurrency market cap drops, we can expect altcoins as well to be bleeding during this time. So at the moment, we have a very major strong support zone in this red box here. I can expect the price to somewhat enter this level, maybe find some support before breaking upwards. If we break upwards here, altcoins will get absolutely hammered and drop a lot more. Bitcoin can push upwards and take the lion's share of what little market cap we have remaining when it comes to the total cryptocurrency market cap, especially if that continues to drop. Or we can see a crash downwards here, either have some relief for altcoins or again, have an extensive crash in the market. So we do have to keep an eye on this. At the moment, we don't really have much to go off in the sense that the direction is very much unknown. It does rely on a lot of other factors. We can only use it at face value and really determine what is happening rather than what is going to happen using a Bitcoin dominance chart. So with that being said, guys, I just want to quickly introduce one of my new favorite exchanges, Bitget. I wanted to quickly introduce my new favorite exchange, Bitget. Bitget is a non-KYC exchange, which is particularly beneficial for members in the UK and Australia who are limited by certain trade restrictions. Bitget has 250 plus spot trading pairs, as well as 60 plus leverage trading pairs, up to 125x leverage. Sign up now in the link in the description using our referral code to get up to $153 in rewards for completing 4 separate tasks. Let's go ahead and dive back into the video. Okay guys, let's get into our long-term price predictions for Bitcoin. So this is our 24K prediction, and we gave this one a very long time ago. I think it was the 16th of November. We gave this one in our Telegram channels for VIP and a free Telegram channel, telling you guys that we did a ratio analysis between the 200-day moving average and the distance between there and where we think the price of bottom will be, which is the 11th of July, calculating the distance and the rise of a run, giving us a estimated price of 24,000 before or on the July 11th. As we can see, the price has pretty much followed this perfectly, having that initial drop down to $40,000 as expected over here, bouncing around $40,000, pushing up for a high, back down to $40,000, up to a high, and finally we are en route or about halfway through this drop down to about 24,000. I do want to talk about the 100-day moving average here acting as a major support. Before we talk about the rest of it, we can see in the past the 100-day moving average has acted as a pretty significant support line on the weekly. We see one instance over here, the green box. We've seen the 100-day moving average acting as a major support along a period of about 6 or 7 months. We also see over here when we finally lost the 100-day moving average, that is when we saw a significant drop down to the 200-day moving average. And we see 2 other instances here where the 100-day moving average has acted as a major support before we actually have that drop down to the 200. I do want to bring up one notable thing. Every single time we come down and touch the 100-day moving average, we eventually head down to the 200. So the first time we touch it is over here, we eventually head down. The second time we touch it, we go up to an uptrend, come back over here. First time we touch it, we head down. The second time we touch it, we head up into an uptrend. This was obviously, this instance over here was a black swan event, but same kind of theory. When we drop the 100, we end up into a downtrend. So what does that say for now? Well, it says we have 2 options. Option number 1 is we can find support here and bounce around a little bit, moving sideways, or we can just quite literally just tank it down to the 200-day moving average. I think either or is likely. I actually don't really care which occurs. I'm not going to try to predict which occurs. The fact of the matter is, if history has shown us anything, every time we come down and even touch the 100-day moving average, we eventually make our way to that 200. So it might take longer than expected. It might happen just as expected, but the reality of the fact is that we are very, very likely going to be touching that 200 before we make any new highs on the Bitcoin chart. I wanted to also talk about the ascending channel formation that we have and how we can take a measured move. If we go ahead and look at on a macro time frame, take our measured move from the top of the chart to the bottom of the chart over here and apply that distance to the top of the breakout point, so the top resistance, drawing a line down, obviously taking off log scale. Sorry, one quick second over here. Let's take off the log scale, do exactly the same thing. And we can copy and paste that over. Where does that take us on the price chart? It takes us to $12,000. So according to the measured move breakdown, we see a price target of around $12,000. I'm not going to say that is set in stone. I've been saying every time I bring this up, I make sure I really drill into you guys that I don't think this is going to happen. This is just the worst case scenario. So what does this tell us? It means that we will never probably never see Bitcoin go below $12,000 in my opinion. I think this is the absolute lowest point that it will go based on the market analysis. And if it goes down to this level, I will be absolutely heavily buying up Bitcoin. But like I said, our initial and long-standing price target is $24,000 according to this chart. So next up, I just want to quickly talk about the Ichimoku cloud on the monthly. We're going to go ahead and delete everything on this chart, swap it over to a monthly chart. Let's go over here, bring up our Ichimoku cloud, turn everything off except the baseline so you can see my settings over here. And we're going to go ahead and plug in the 200-day moving average, tune into a 7-day chart. You can go ahead and put input, time frame at 7 days. All right, and here we go, is our chart right over here. We've got a few notable things I do want to mention. The first and foremost is going to be on our red lines we're going to draw. The red lines are our breakdowns below the baseline on Ichimoku cloud on the monthly. Every single time we have a breakdown of this level, we are followed by a pretty significant drop down towards that 200-day moving average. We're going to go ahead and draw it in. We break down, we move to the 200-day moving average. We break down, we move to the 200-day moving average, and we've broken down again. All right. I do also want to bring up another notable thing, which is every time we retest the baseline as support after we've reached the 200. So only after we've reached 200, we push back up and retest it as support, we end up making new all-time highs. So we push up to a new high, and we can see exactly the same thing occur over here on the 1st of May. We push up to a new high only after retesting that 200-day moving average. So this can indicate something similar to that 4-year cycle. It's not exactly 4 years, but it can show some significant data, especially in regards to where the price will be heading. And of course, we have confirmed that breakdown from the baseline, indicating that we have in fact started this drop down towards that 200-day moving average, which will most likely see itself through, as we've been talking about in our previous analysis. We're going to go ahead and jump back to the 3-day chart, and I want to talk about the RSI this time. Now the RSI, we did a video I think maybe 2 or 3 weeks ago on the RSI, talking about a particular level on the RSI, which has been, I guess, pretty good at predicting whether or not the Bitcoin price is going to see a rapid crash or a kind of a slow bleed. And that is in fact the 34.34. I'm going to go ahead and zoom up a little bit. 34.34 was close enough on the RSI. So if we go ahead and look at every single time the price drops below the 34.34 on RSI, we're going to go ahead and draw some lines in, which is over here. We saw a drop below around this level as well. We saw another drop over here. We saw another drop back down over here. If we go back in time a little bit as well, we can see more drops. Of course, we have our drops over here. And again, once more. And finally, we have a drop down over here. So we have a couple drops down on the 34.34 on RSI. Let's go ahead and analyze what actually occurred after these drops. We can see every single time we drop down, we end up having a significant crash. We saw a 25% pullback this time. The last time we dropped down, we saw a 38% pullback. When we dropped down on the 7th of May, 2021, or 2020, COVID crash, we saw another significant drop down, a pullback of 56%. The drop before on the 2018 in December, we saw a 55% drop down when the RSI broke. Moving all the way back to the 15th or the 1st of January 2015, we saw a 50% drop down. The 14th of August 2014, we saw a 25% drop down. And if we extend all the way back to October in 2011, we saw a 50% drop down. So the RSI has been pretty handy at predicting these large flash crashes or periods of rapid short downtrend price action, which have been quite abrupt and aggressive in the Bitcoin chart. So it's definitely something to keep an eye on, since the price of the RSI is starting to move down towards that 34.34. And I think what's going to happen is that 34.34 is going to be retested as the price of Bitcoin reaches low to mid 30,000s. And I think if we lose that level, that will be the trigger, or that will be the spark that ignites that drop towards the $24,000 prediction we have had for months and months and months. Over 6 or 7 months now we've been talking about it. I think that is going to be a catalyst of a trigger for that. Let's go ahead and talk about the Federal Reserve and interest rates and the effect on the economy. So as you probably have heard, the Federal Reserve announced that they moved their basis points up by a 50-point basis point hike, which was the largest move in 22 years since the year 2000. They also announced that they're going to start reducing the asset balance sheet of $9 trillion. So what does that mean? They're basically going to start selling off, the government's going to start selling off some of their assets as well. If we take a look at the DXY chart, we can see a few things. First and foremost, for those of you who do not know what the DXY chart is, DXY is a visual representation of the discrepancy between cash and assets. So when the DXY increases, we know money is outflowing from assets and inflowing into dollars. Vice versa, when the DXY decreases, we know that cash is outflowing from money is flowing out from dollars and into assets. Now, we're going to go ahead and quickly talk about this little diagram, then we'll come back and talk about the DXY. So obviously we have had a period of very high inflation. All right, that has been because of obviously increased government spending, economic funding through inflation, economic funding through debt, COVID-19, a whole variety of other things. But most importantly, the fact that the government has been printing a crap ton of money. That has resulted in a state of which cost of goods have increased massively and living costs are getting too high. Therefore, interest rates have had to rise. When interest rates rise, we have increased interest payments on our debt. All right, obviously interest increases interest debt payments on your loans, and we're going to talk about it a little bit now. So household loans primarily consist of mortgages and short-term cash loans. What happens when interest rates rise? Well, there is less available household cash to be spent. Therefore, the supply and demand balance of cost of goods gets shifted and the cost of goods start to rise. What happens when the cost of goods start to rise? Again, household spending decreases, or increases, but available cash flow decreases and average savings decrease. Therefore, you have retail investors starting to liquidate their assets, whether it be, and generally it's liquid assets. So liquid assets include houses, particularly in Australia where the RBA just increased interest rates, and houses can be purchased for residential purposes by retail investors, as well as companies, superannuation funds, and governments can acquire residential complexes and buildings. Those will start to fall in value as those are liquid assets. We also have risk assets such as cryptocurrencies, bonds, stocks, all these things that are easily able to be liquidated into cash quite fast are going to be liquidated. And I've been warning you guys for months, and it's already started to happen. We're seeing the prices of assets drastically fall. And this is because of retail sellers, and we'll get into the companies in a second, are forced to sell assets at a loss or at a profit to fund basically their survival. So moving in, how does that actually impact the economy, and how does that impact, I would say, the current state of our financial situation in regards to cryptocurrency prices and asset prices, like shares and stuff like that? We already know that the market, market movers basically move the markets, and people who move the markets generally have the lion's share of the supply. So who contains the lion's share of the supply? Companies. Companies contain or hold the majority of these assets. Now, companies notoriously have been accumulating a lot of assets on very, very low credit money, which means interest rates have been incredibly low for the last couple of years. Therefore, companies have been acquiring a lot of assets on debt during this period of low interest to increase their cash flows and earnings, their future earnings, because they have more assets. Therefore, the share prices of these companies have gone through the roof. All right, share price is based on future earning capacity, and if your company owns more assets, your future earning capacity increases. Companies have been acquiring these assets on low credit money because interest rates have been low. Therefore, they can take a lot of loans, acquire a lot of debt without jeopardizing their cash flows and their available cash to pay off these low credit loans, while increasing their future earning potential, which has caused the share market particularly to absolutely explode. Now we're seeing the reverse effect. Interest rates have started to rise. Companies now have a lot of debt which they need to pay off, and their asset prices are starting to decrease as they are offloading these assets to repay their debt, to increase their cash flows on their balance sheet to make their companies appear less more favorable and healthier on their balance sheets. So you have a situation now where companies and retail investors are selling their risk assets, particularly cryptocurrency shares, easily liquidatable assets, to increase their cash flows as interest rates start to rise and the cost of goods start to rise and household expenditure increases and household available cash flow decreases. Everything I just explained to you right now is half the part and reason why Bitcoin has been crashing, why the stock market has been crashing, why it will continue to crash in the future as interest rates continue to rise upwards. And 0.5 basis points is just the beginning. They're going to go 0.75, they're going to go 1, they might even go 1.25 in the future. Interest needs to rise, inflation is too high, the cost of living is ridiculous. So what does this tell us about the DXY? Take a look at the DXY, guys. Everything we just talked about is visually represented on this chart. We're broken out of a 22-year long symmetrical triangle. I wonder why 22 years. Guess when the last time they increased interest rates past 0.25 basis points was? 22 years ago, 2000. Not a coincidence. We broke out the 103 major horizontal resistance. Guess what? We did that when we increased 0.5 basis points. So all these things are falling into action. They're going to keep rising, the DXY will keep rising, asset prices will keep falling. And even if I'm wrong, even if it flips around and spins on its head and goes the opposite direction, even if I'm wrong, we can only go on the data we have available at the time. Therefore, investing with the expectation of long-term profits right now is a very, very short-sighted and narrow point of view. You're only exposing yourself to a ridiculous amount of risk, thinking that just because the prices are cheap now in comparison to what they were 6 months ago, that you are going to make profit and you're going to go to the moon and you're going to be successful. It's not going to happen. There's a pretty high chance you're just going to get wrecked. All right, guys. So let's go ahead and answer our community question next. So our community question, I'm going to go ahead and bring it up on the screen. Let's go ahead and find. I've got one of my files over here contains it. Here it is. So it is from our long-term subscribers, Vignay, and again he says, MegaWhale, I have a question on why every coin is dependent on Bitcoin. When Bitcoin goes up, every other coin rallies, and vice versa. Why is this the case? So it goes back to the old saying, or should I say, it goes back to the total cryptocurrency market cap and Bitcoin dominance. I'm going to answer it in a couple sentences really quickly and really easily. It's because individual assets within an asset class is less correlated to the asset class performance as a whole. So I'll expand on that in a bit. So for example, Bitcoin makes up 42% of the total money in cryptocurrency, and thus, therefore, Bitcoin is a great reflection of the health or the overall health of the market. Therefore, it's not that when Bitcoin rises, everything else seems to rise, or vice versa. It's when the market is healthy, all assets within the asset class, so all cryptocurrency assets within the general cryptocurrency asset class, they rise. And it just so happens that Bitcoin holds the lion's share of the funds in cryptocurrency, and thus we use Bitcoin as a basis of cryptocurrency performance and overall health. So I hope that answers your question. I hope it makes sense. And if you really analyze what I just said and really break it down, you can understand and apply that to a chart and it can make a little bit more sense. Anyways, I just want to finish off by introducing the Crypto Academy. We're just launching in a few more days the Become a Trader 10-unit course, which basically myself and Wolves of Crypto have come together and combined our knowledge to teach you guys absolutely everything we know about technical analysis, market analysis, long-term trading, short-term trading, different technical indicators, market patterns, a variety of different things. Basically, you'll go from a novice or someone who's got a few years of experience trading or even no experience trading to someone of 4 or 5 years of professional trading within 10 units. Now, the amazing thing about the course is you can study at your own pace, and all the information we provide you is absolutely timeless, meaning it will not expire. You can go look at it in 10 years from now and it will be solid and remain constant. If you want more information about that or join up the course, you can contact us in the email in the description below, cryptoacademycourses@gmail.com. If you have any questions or you want your question to be submitted for the next video, leave it in the comments below and I'll catch you in the next one.